Hi guys, John Patrick Mullen here for Forbes Digital Assets. Today I'm here with none other than Mark Lamb, the CEO of CoinFLEX, the first physically settled Bitcoin futures exchange. Today we're going to compare and contrast a little bit about what that means compared to cash settlement and what they're doing being the first one in the game. How are they going to take on the guys down the street like BitMEX as well as the ones across the pond, Bakkt. So without further ado, Mark, could you maybe give us a little bit of a brief intro to yourself, CoinFLEX, what you guys do, and then a little bit about what the heck happened last night with the Bitcoin price.
Yeah, absolutely. So I've been running crypto exchanges for about 6 years and started CoinFLEX towards the beginning of this year, basically as the first exchange to do physical delivery, which Bakkt has recently launched a similar product in the US. And the big thing about physical delivery is that it provides a level of trust and certainty over a futures contract that you just don't get with cash settlement, which is basically every other derivatives exchange, BitMEX, CME, all of them use a method called cash settlement. And so we're really excited about physical delivery. We think it'll be 95–98% of the Bitcoin futures market. But what happened this week and last night, in fact, was basically, I think the market was expecting a really high amount of initial volumes on Bakkt day one of launch and week one of launch, and didn't see that. And at some point, someone or many people in the market said, well, if Bakkt isn't bringing the kind of institutional volumes that we were expecting to see in the space, Bitcoin's probably overpriced. And so there's a big correction, and it dropped as low as into the 7,000s on some futures exchanges like ours. Ultimately, I think there's a little bit of overreaction, and most of the futures trade, it's somewhat of a misconception between, how futures and the futures ecosystem will look like over time.
Gotcha. I mean, I even heard that there was, and maybe some of the others saw that there was also some sort of potential market manipulation on BitMEX, big whales that are, basically taking advantage of the fear and the FUD of Bakkt's, let's just say, not monstrous launch. What do you think about that? How do you think that has impacted, and why do you think you guys can combat manipulation in the market?
I think in an instance like today and yesterday, it's impossible to say. There's so many factors that it becomes very difficult. But on quiet days, when you see huge spikes that are purely happening on one exchange that is part of the settlement index of one of these cash settled futures exchanges, it's you can say with a very high degree of certainty that there's manipulation in the market because of cash settlement. So that's one thing we're trying to combat. We also think physical delivery is very important, not just to prevent against manipulation, but also because it enables the type of borrowing and lending that institutions in the space want, miners want, commercial users, payment providers, and various other players want. It's just a maturing of the crypto futures market. And
gotcha.
So, yeah.
Gotcha. I mean, that makes a lot of sense, and obviously there's a big hype surrounding the institutional inflows that Bakkt is going to bring. So in that regard, could you give us maybe some comparisons about some of the features and options that you guys have, optionalities that you guys have as compared to Bakkt, in terms of leverage, in terms of, obviously you're both doing physical settlements, but leverage, they're based in the US, you guys are not. How does that play into kind of the market that you're trying to attract, or people you're trying to attract on your exchange?
Sure. So when you think about institutions in crypto, institutions have been able to buy cryptocurrencies for many, many years. There are regulated spot exchanges. There's OTC desks that are run by very, very large established counterparties. So buying crypto has not been really an institutional issue. Buying it in a way where there's leverage, i.e. a futures contract, is always something institutions want. Institutions are ultimately leverage junkies because what they're doing is it's a return on capital equation. It says how much trading can you do with the smallest amount of capital possible, large amounts of leverage in a very safe way that can generate you high kind of low risk returns.
Sure.
And so when you think about what an institution wants, lots of volume and high leverage and high return on capital, it's actually unclear that a U.S. regulated U.S. regulated futures exchange is what's going to end up being the majority of the market.
Sure.
Because mostly all these features, the high leverage especially, are found on offshore offerings like ourselves. So
how much leverage do you guys offer?
we do 20x, and a lot of the institutions are actually using way more than what's allowed by CME and Bakkt. So
Sure.
CME and Bakkt, Bakkt is about 2.5x, CME is 2x. So for most institutions, they're looking to use 5x, 10x, sometimes more than that, and they want the
100x.
ability. Definitely not 100x, but the nice thing about 100x is it makes her a very good testing ground for a small trader who's looking to get their feet started. So it's something we're looking at rolling out at some point. But ultimately, the beauty of leverage is it allows you to trade way more than you have, and for institutions, that's critical because they're capital constrained. In the case of prop trading firms, in the case of people with other people's money, they have constraints on what they can do with the capital. So either way, they're going to be constrained in different ways, and leverage allows for a lot of things to happen that can't happen on onshore, kind of U.S. regulated venues.
Gotcha. That makes a lot of sense. Well, thank you so much for your time and insights today. It's great to see kind of the battle that's ahead between the physically settled futures exchanges. Wish you all the best, and thanks for your time.
Yeah, thank you so much.